Despite this to and fro between the ceasefire, whether it's on or off, fresh missile strikes by Iran have been made in early hours this morning over northern Israel as well as Haifa. Well, joining us this morning is a very special guest. We have Mr. Vivek Kumar, economist at QuantEco, joining us this morning. Vivek, good morning. Help us unpack what the ceasefire or the lack of it and the volatility emerging from here could mean for the Indian economy, especially oil prices, which have now at least finally come down to the pre-conflict levels, at least early morning today.
Hi, Kartik. Good morning. So I completely agree and completely empathize with market participants here with respect to how the crude oil prices have behaved in the last 1 week.
Right.
So it's been a complete roller coaster ride, all the way up from 65, maybe a week or two back, to somewhere close to almost hitting the 80 level mark on the Brent.
That's right.
And everything has happened within a span of 1 week. So it does create jitters because you tend to do your planning with respect to export and import requirement. You tend to take your investment decisions based on some of these international commodity prices and their signals. And if there is volatility of this kind, it is definitely not something which is conducive for long-term business decision making. Now that's the basic underlying, but from a short-term perspective, I think what we need to keep in mind is where were we as a nation, as an economy, in the previous financial year. In the previous financial year, the average price of crude oil, so when we say crude oil, I'm typically referring to Brent here, was around $79 to a barrel. So everything else gets benchmarked against that. So if your economic performance, let's say GDP growth of 6.5%, inflation coming down to 4.6% last year, current account deficit or the gap being extremely healthy at 0.7, that's what we estimate for last financial year, is somewhat going to get replicated if crude oil stays closer to that levels. So we saw it hitting the 80 level mark. If you assume that there is a serious escalation and crude oil prices does stay at least $80 a barrel, then you could expect a similar outturn from as far as the economy is concerned in FY26 as well. So the expectation that it is going to lead to a severe negative spillover probably will not hold as long as crude oil prices stay somewhere in the vicinity of $80.
Okay.
The test will be if you have crude oil moving towards the triple digit territory, which is crude oil. That is where the absorptive capacity starts yielding to the pressure. And you could start seeing strains developing on the inflation front, on the current account deficit front, maybe also on the fiscal deficit front.
All right. Of course, so a lot of uncertainty and a lot of parameters to watch out for. But I want to specifically come to this concern that a lot of economists in India had and across the world, in fact, about the Strait of Hormuz and its closure, which could have really sent oil prices, touching the sky. But that is something which, as of now, at least seems to have been averted. Let's assume for now that the ceasefire, with at least 2 out of the 3 trilateral parties agreeing to it, US and Israel, and we are yet to hear whether Iran will eventually agree to the ceasefire or not. But from what it seems right now, that the Strait of Hormuz is unlikely to be impacted, at least immediately, if the ceasefire talks were to materialize. So, how much of a good news do you attribute that to be, Vivek, for the Indian economy, where about 40% of our oil imports come through that strait?
Yes. So before I do that, first a disclaimer, I'm not a geopolitical expert, but nevertheless, I think the signals that you capture is that it's definitely a relief while our dependence on Iran as a country for imports, especially the energy imports that we're talking about, is fairly low. So we do not import much. In fact, if you put both Israel and Iran together, our trade would be less than 1% of total exports and imports put together. So imports is even less than 0.5%, both Israel and Iran put together. So it's a fairly low share of our trade dependence on both these countries, especially Iran. The problem happens not because the dependence is low, but because Iran sits at that strategic point where it tends to control one of the most important global choke points for maritime oil trade. And although we do not trade directly with Iran, but a lot of petroleum or energy related import passes through that strait. And that share is as high as 40 to 50%, depending whether you're talking about crude oil or whether you're talking about gas, natural gas per se. So that is where I think the entire equation gets interesting and it gets a little bit more concerning. Now, for us, it's a relief that it has not happened. Whether it can happen or not in the near future, we don't know because the instances of such closure have been extremely rare in the past. And we also need to keep in mind that if at all such a drastic step were to be taken by Iran, then it is going to harm itself as well as some of the very important countries like China and maybe some of the Asian countries. So it is going to be uh, the economic damage will be limited to Asian countries, especially China. And the West, probably Israel, or for that matter, US, is just not going to be impacted by the oil disruption. Can the oil disruption, if at all were to happen, can it get replicated by some of the existing suppliers? Well, yes, there is a possibility that Russia could pump more. There is a
Right.
possibility that OPEC could do more. US already seems to be now doing much more than what it was doing a couple of months back. So, in theory, there is a possibility that the disruption that can potentially be caused by the closure of Strait of Hormuz might get replaced. Maybe not in the immediate week, but if you
Right.
give it a couple of months, it should get replicated. So that also probably explains why, Kartik, the markets have not reacted very adversely to the news. In fact, oil struggled to beat that $80 mark.
That's right.
And in fact, as we speak today, it's now below 70. So it's actually a relief that the market participants are treating it as a one-off or maybe a disturbance which is not likely to last long, even if it were to.
All right. And now talk to me, Vivek, about the dollar index. What happens to the US dollar given two scenarios? One scenario that the ceasefire comes into effect immediately, and another being that this continues to be a slightly more prolonged war beyond the 12 days of action that we've seen already. What happens to the dollar index? And then, in turn, how is the Indian rupee going to fare?
Perspective, let's say we assume that the ceasefire is in operation and it probably persists for a longish period, then things will fall back to normal, where the market attention will once again fall back to what's happening on the trade deal front. And of late, there's a new variable which is now becoming increasingly much more relevant for dollar is what is the Fed going to do? As far as the last policy outcome is concerned, the Federal Reserve has stuck to the previous forecast of 50 basis points cumulative rate cut in 2025. But increasingly, it is looking as if there are a little bit of concern which is emerging on the labor market front in the US, especially. And given the kind of political pressure which is there to ease interest rates, there can be a possibility that the Federal Reserve might start easing even before the September window that most market participants were trying to price in.
All
Now,
right.
with crude oil prices reversing its course within a span of, let's say, a short span of 10 days, the argument for the Federal Reserve staying on a cautious mode for a longer period of time also does not hold. So that's under the assumption that the ceasefire remains on operation and oil prices continue to trade in sub 70 levels. If, on the other hand, you're talking about the other extreme scenario where ceasefire is not maintained and you see further escalation, then you could probably see a situation where the Fed probably stays on cautious mode for longer,
Okay.
which is likely to be supportive of the dollar. So two extreme scenarios are likely to have exactly opposite impact on the dollar.
All right, Vivek Kumar, thank you so much for your time this morning, and thank you for really unpacking all that's happening and how this impacts the economy.